What we're seeing is the inflation trend, first of all, is on a good, healthy downward trajectory. So that's good. But more recently, we've seen that the labour market has been showing signs of weakening, which is quite natural at this stage of the economy. But if you look in more detail, there are different indicators we can look at. There's the overall employment growth, there's the unemployment rate, there are different surveys, and the overall mix of data is actually very much in line with a weaker labour market, but a soft landing for the US. What does that mean? So you're not moving into a recession, but the economy is slowing nonetheless. And that's quite natural considering where we are in terms of monetary policy. Interest rates have been elevated for a meaningful period of time. They're not confident enough to say, well, we've slain that dragon, but they are confident enough to start thinking about the unemployment rate and getting ahead of that loosening in the labour market.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Sree Kochugovindan. She is Senior Research Economist at Abrdn. And today, we have the pleasure to go around the world and talk about all the different economies around the world. And we're really lucky to have someone with such a in-depth knowledge of economics on the show today. So welcome, Sree. How are you today?
I'm good, thank you. And thanks for having me on the show.
Yeah, it's a real pleasure to have you on today. So, today we've got a jam packed show. I think what we're going to do is we're going to start off in the US and then we're going to go to all the different major economies and just go over really what's happening in the economy as you have a lot of experience in all areas of the world. Uh, just before we get started, I wanted to ask you to provide a little bit more detail about your past experience and a little bit about your role at Aberdeen.
Yes, so I am an economist at Aberdeen Asset Management firm within the investment side. I've been there for 5 years. Prior to that, I was a strategist, asset allocation strategist at Barclays Investment Bank. So I was there for 17 years. Prior to that, I did a PhD in economics, and that's where my research interests were really driven there. And I did an internship during that period of time in FX strategy, and that's where I discovered markets and how I could apply my macro to markets, and I've been doing that ever since.
Great. And what actually appealed to you about economics when you started to?
Yes, I think when I was at school, I never really thought about economics as such, but I was very interested in current affairs, and I wanted a deeper understanding of some of the political arguments and what was happening in the world. So I fell into it by, in essence. I wanted to do journalism, but then started doing an economics and politics degree, and then found that actually the economic side was more of an interest for me, and I felt that it provided a lot of other political questions as well. So that was my take on my studies, and I've just been doing it ever since.
Yeah, you're right. Economics go hand in hand and politics because one affects the other. And you see a lot of patterns in that. So, oh, that's really great. So, yeah, it's really great to talk to an economist about all these different areas. So, the first question, if we start off with the US, I just wanted to get a very brief summary from you about the health of the US economy at the moment and some of the major talking points.
I think we've seen a very strong focus on the US economy. It's the main driver for markets. What's happening with the Fed? What's happening with the US economy? Now, if you think back during this year, we've seen sentiment in the markets really shifting from recession risks, inflation risks, first of all, so recession risks, and then soft landing or strength of the economy. What we're seeing is the inflation trend, first of all, is on a good, healthy downward trajectory. So we are seeing disinflation trends in place. So that's good. Now, obviously, you get one or two numbers here and there that can be a bit stronger. Potentially this month we could see core PCE being a little bit hotter than it was last month, but the overall trend is very much intact. So that's good news, particularly for the central bank, particularly given where we were during the pandemic. Now, the other side of the coin is what's happening with the labour market and growth activity in the economy. And we had a couple of distorted numbers over the summer, which led to a bit of a sell-off in markets and the carry trade unwind, which we can talk about. But more recently, we've seen that the labour market has been showing signs of weakening, which is quite natural at this stage of the economy. But again, it's a very bumpy path. So we had a very strong number recently in terms of the US payrolls number. That was well above what markets had been expecting. And there were some upward revisions to that particular number. But if you look in more detail, there are different indicators we can look at. There's the overall employment growth, there's the unemployment rate, there are different surveys, and the overall mix of data is actually very much in line with a weaker labour market, slightly higher unemployment rate over the coming months as expected, but a soft landing for the US. What does that mean? So you're not moving into a recession, but the economy is slowing nonetheless. And that's quite natural considering where we are in terms of monetary policy. Interest rates have been elevated for a meaningful period of time. That tighter monetary policy is definitely feeding through. And now the Fed is shifting its focus, obviously, away from inflation. They're not confident enough to say, well, we've slain that dragon, but they are confident enough to start thinking about the unemployment rate and getting ahead of that loosening in the labour market. So we're starting to see that pace of easing, which has begun with a bit of a bang, with 50 basis points cut initially. And now I think it's going to be more likely a 25 basis point cut from each meeting from here. It's a quick summary there.
It is, yes, it is. So you mentioned that you thought it was going most likely to be a soft landing rather than a deeper recession. But there are some indicators which say we could be in for a recession. I'm thinking one about the SARM indicator. Is there any other indicators that do show that it could be potentially a harder landing than expected?
Yeah. So I think the SARM rule is literally based on just one number, one indicator, which is the unemployment rate. And that is now, the unemployment rate has ticked into the territory, which would historically suggest that we are in a recession right now. But Claudia Salm herself has said that this time could be different, dangerous phrase, but this time could be different because that one number on its own is not enough. There is the overall backdrop as well that we need to think about. But you're right, there are risks. And I think one of the risks is sentiment. So some of the other indicators that I was suggesting, for example, consumer confidence, if you look at the breakdown of consumer confidence, there are more people answering the question that jobs are harder to get. So that indicator is signaling some concern in the labour market, some concern in potentially that could spill over into consumer spending as well. So if you think about the fact that we built up a savings buffer during the pandemic, but that has been to some extent run down already. That helped buffer the impact of higher inflation. But now we're in a territory where tight monetary conditions could actually be hurting the consumer a bit more than perhaps the Fed are expecting. But I don't see that as a base case, but there is a risk there. Some of the risks going forward could be, what if there is another spike in commodity prices that can hurt the US household? There are risks there, particularly with geopolitics as they stand at the moment. What about policy next year? I think the US election is going to be quite critical, and we can talk a bit about that. But some of the policies, if there is the introduction of fairly steep tariffs, then that's going to be another spike in the price level. Inflation will tick up quite dramatically potentially. And that's something that it's a price level shift rather than inflation. So that will start to unwind over the course of 2025, but you could see an impact on the consumer spending. And the consumer is really the key driver of the US economy. So there are some risks there that could tip you into recession. So it's one of the risks that we're considering. We also get questions about risks of higher inflation going forward. But as I think we discussed, we can talk a bit about inflation volatility going forward, because I think we've come out of the pandemic, but we are in a slightly different regime given the geopolitical risks and some of the supply side shocks that we could be enduring. So there are a number of risks that could materialize next year. But as it stands, the Fed have started to ease ahead of these risks and can always pick up that pace of easing going forward. So there is a buffer there from the central bank policy.
And consumers in the US, obviously, they built up that big buffer of savings during the pandemic. Most people have used those savings now and have actually gone into large amounts of credit card debt. And we're starting to see some delinquencies in terms of people not being able to pay back their credit cards, etc. Do you see that kind of bleeding out to being a larger problem as the months go by and as interest rates, although they are coming down, they're still relatively historically high?
I think that is one of the risks, definitely. But I think it really depends on household incomes going forward. So I would put that within the context of the Fed have started to ease. They're very early in that easing cycle. We expect another two interest rate cuts this year, another five next year. So we've got a long way to go in terms of offsetting that squeeze on credit card debt. It is a problem there. But I think what would be more important for the US consumer would be the state of the labor market and business sentiment. And I think that's going to be quite critical because at the moment there's a lot of uncertainty and probably things are on hold ahead of that election result because the outcome of that is not just a binary outcome of who wins the election, but it's also how they win and whether they take the House and the Senate in terms of how much policy they can actually implement. So we don't really have the contours of policy for next year yet. So I think there'll be some business uncertainty. So we need to clear up some of those questions and boost business confidence and consumer confidence. So I'd agree that credit card delinquencies are part of the story, but it's not going to be the only story for determining the outlook next year.
Okay. And on interest rate policy now, obviously, we saw a 50 basis point cut at the last FOMC meeting. From your analysis, what are you expecting in terms of coming out until the end of 2024 and moving into 2025? How low do you think they'll cut the interest rates?
Yes, I think it was a bit of a big bang start. The minutes of the last meeting from the FOMC, there was a pretty intense debate and a broad airing of views, but it does look as if the data at the moment suggests that they don't need to do 50 steady increments of 50. That was quite an aggressive start, necessary perhaps given the data that they knew at the time. But going forward, I think the economy is not falling off a cliff edge. So I think 25 basis points in November, December, and another 125 basis points next year, I think is what we have penciled in. But again, this is all conditional on a fairly benign outcome for markets. The Fed does take that into consideration and a benign outcome in terms of fiscal policy next year. There's not an awful lot of fiscal room in the US, and you see this as a common theme across Western economies. We're not expecting major stimulus, but again, that depends on how much freedom they have post-election, really, and who gets in.
Yeah, I think I agree with you on that. Okay, and on inflation, I think I've seen in one of your previous papers that you are expecting inflation to be a little bit stickier than it has been historically, and you expect it to maybe have some spikes up and down as time goes on. Can you just explain a little bit more about your theory and some of the work that you've done on that?
Yes. Thank you. So the paper that we were discussing prior to this, there it looks at, it's not just the US, it's looking at global, I think there's like 40 odd countries going back 30 odd years. The analysis is just looking at what are the main drivers of inflation, and let's break down some of the cyclical short-term drivers and the longer-term structural drivers. And it was written at the height of the pandemic when we had double-digit inflation, and it was really trying to address the fact that there's a lot of confusion about how globalization and technology works alongside monetary policy. The main findings of that were that inflation expectations were critical. So, and that's why the central banks had to be so aggressive with monetary policy, and interest rates had to be as high as they were for as long as they were, and they were kept on hold. And you can break down inflation into the main parts. So commodity prices were one aspect of it, supply chain disruptions were another, then the labor market. That was the last sticky side of the story where wage inflation was really quite strong. And that was where central banks were very concerned. They didn't want a 1970s style wage price spiral. And that's where inflation expectations were so critical. And so you often heard when inflation was at double digits. And it started to come down, but core inflation remained stubbornly high. That's no longer the case. We are starting to see labour market weakening, and therefore wage growth is starting to stabilise. And that was a very important part of the story. But the central bank action, historically, that's been quite critical in determining longer term dynamics. And this constant comparison with the 1970s wasn't quite relevant for today. And that's what we were trying to tackle in the paper. So if we look at some of the drivers such as globalization, technology, how do they work? Well, over the last 20, 30 years, they've actually been a force for disinflation. So the fact that we had a very globalized labor market, globalization can be in many different forms. It's not just the trade of goods, freedom of movement of goods, it's diffusion of technology, shared knowledge, movement of labor. All of those drivers were coming together to really suppress inflation over the course of 20 odd years. Now, some of those drivers are shifting. We've seen the impact of supply chain disruptions, blockages of shipping routes. These are all factors that we're still challenged by. But if you think about the AI boom, there's a lot of debate about, well, how does that impact productivity growth? How does that change our working lives? Technology historically has been suppressing inflation. And that's how it usually filters through into longer term drivers. Deglobalization, or I think that's a bit of a strong phrase, reshoring, friendshoring, it's very difficult to disentangle supply chains that have taken so long to integrate. But there is some dismantling of that. It really depends on how it's done. So if you take Japan, for example, there's a lot of investment in technology, robotics, and AI as part of that globalization story. So it doesn't necessarily have to be this inflationary force, but it does provide the overall backdrop. So over the last 20 years, prior to the pandemic, that structural backdrop was disinflationary. It's not necessarily the case now. So what does that mean? It means that we're a little bit more sensitive to geopolitical shocks or supply shocks. And that's a slightly different environment than we were in previously. So what can happen is that headline news can really shift sentiment and expectations, and we are more vulnerable to inflation spikes. So, for example, if we do see some of Trump's policies that are being talked about now, if we do see a clean Republican sweep of both the House and the Senate, then you can have a freer rein in terms of policies, potentially. But some policies you can get through executive order. So tariffs are the most likely outcome if we do see a Trump presidency. So that'll be a level shift in prices. But then it just means it's a more difficult backdrop for central banks going forward. So where I've talked about a fairly benign outcome of slightly looser labor markets, disinflation trend on track, and you can just ease another 25 basis point pace, perhaps the Fed will be forced to pause if there are inflation spikes. So a lot is very conditional upon future policies. So the backdrop, you can take the longer term backdrop of demographics, tech, and globalization. That just makes everything a little bit more inflationary. The demographic backdrop just means that wages, our workforces in certain countries are smaller. So wages are going to be structurally higher potentially. And if you force immigration flows to slow down or stop, then that will be inflationary as well. So there's a whole bunch of drivers that can be a bunch of known unknowns for now that we can see can add to this inflation volatility. And that's something that central banks are very much aware of, I'm sure.
Okay. And you mentioned about some of the policies that Donald Trump could potentially enforce, such as tariffs, if he was to win the election. What would Kamala Harris' election victory look like in terms of policies? How would it differ from a Trump victory?
I think in terms of where we are at the moment, a Harris victory is probably going to be more continuity. But again, some of the policies there, it really depends on how she wins the election. And it does seem unlikely for a democratic clean sweep. So again, it's going to be quite a restricted fiscal backdrop. There are some concerns about things like corporation tax being not as high as Biden was proposing, but still higher than under a Trump presidency. So there are concerns about that with business sentiment. Again, these are all things that need congressional approval. So if there's a split Congress, then again, she's going to be restricted there. But also, her policies are not too dramatically different to what we already have. And there is this sense of, I think the phrase is vibe recession. There is a sense that, under Biden, the economy hadn't done very well, and Biden is often blamed for inflation when in fact these were pandemic or war driven factors that were leading to higher inflation. And the economy unemployment rate was relatively low going into this election. So I think there is a perception issue there that the Democrats have faced, and hence the changing candidate. So, but ultimately, it's pretty much business as usual under a Harris leadership.
Okay. And this year in 2024, we've seen a lot of the big gains have come from the large companies, which are often referred to as the Magnificent Seven. An outsized number of gains have come from those particular stocks, and some of the rest of the market has lagged somewhat. Does it worry you a little bit in terms of, from an economic side, that the market breadth at the moment is quite shallow in terms of the gains? And what does that indicate?
Yeah, I think obviously there's been a lot of focus on the Magnificent Seven, and a lot of volatility has come from those seven. So it is, I think, from an economic perspective, I'm not too concerned actually, but the way the stock market can channel through into the economy really is the volatility. And in the US, there is a greater exposure there's a greater culture of share ownership. So there, the consumer spending could be impacted for some cohorts of society. So there is a bit of an impact there, and there's a sentiment impact. So there is a lagged feed through into the real economy. So we do need to be worried about. Not worried, but we do need to keep an eye on it. However, the fact that the rest of the stock market, is still relatively resilient. Again, for those companies, it would really depend on their global exposure. How is the global economy looking? What is the fundamentals of their business? And what is happening with the US economy? So a soft landing would actually be, quite supportive of those companies continuing to do relatively well. Maybe not the magnificent gains that we've seen from some of the tech companies, but I wouldn't discount the tech companies completely. This is a very long-term structural story. So even if there are some near-term pullbacks, it's not something that's going to necessarily derail the economic outlook necessarily. It's more of a sentiment issue. How does that spill over to other companies? They have been quite dramatic in terms of how they've influenced the returns of the S&P 500. But so it is something that needs to be monitored for sure. And that's something that we saw. Let's think about what happened over the summer. That volatility wasn't necessarily economically driven either by the Fed or by the Bank of Japan. It was really a flash in the pan sentiment issue, and that's something it's important to understand what it is and look through it and just ask the question, is there a fundamental reason why the stock market will continue to sell off another 20-30%? And those are the moves that are really important for the real economy.
Yeah. I think in terms of those Magnificent Seven, I think a lot of them have been driven by a lot of technological hype that's going on at the moment, like around AI and other areas of development. Those areas of development are always going to be there, right? And they're going to continue to grow, but it's investors' behavior that influences whether they go a little bit above their valuations or they slump down. So I think that volatility is going to go with investor emotions. Yeah. Okay. And with the rate cuts, do you see those benefiting some of the smaller and mid-sized cap stocks that maybe have lagged a little bit this year?
Potentially, yes. It depends, because they would be more typically they'd be more domestically focused businesses. So an easing cycle would be more beneficial for them. I mean, if you think about some of the bigger, whether it's in the US or the FTSE, for example, FTSE 100 is very globally exposed. But if you look at the FTSE 250, it's a bit more of an exposure there to the smaller, the medium-sized firms that are a bit more domestically focused. So there, the interest rate cycle and the domestic economy is much more, that's their client base, and that's much more important. So I'd agree that to some extent that they would be a beneficiary. But it does boost sentiment across the board, right? The fact that the Fed has started to ease, the fact that there's almost this Goldilocks environment, right? There's no recession, but you have an easing cycle, and that's positive for sentiment overall. So that would actually, I would argue, that would boost both large and small caps. So you wouldn't necessarily go as far as saying, well, mid caps are going to outperform, but nonetheless, it is supportive for for that sector as well going forward. But ultimately, it'd be things like currency movements, the global picture. Those would all be factoring as well for the overall market.
Yeah, and they'd also have cheaper access to money and to funds as well. Yeah. All right, excellent. That's a good summary of the US. And now I think we will go to the country where Sree currently lives and where I'm originally from. So now we will talk about the UK economy in general. It's pretty good because on this channel we talk a lot about what happens in the US market. So it's really good to have somebody on who has a real touch on the UK market specifically. So I just wanted to get a very similar summary for you about what's happening in the UK economy, and then we'll drill into that in a little bit more detail.
Yes, I think what we can see here is a bit of a transatlantic divergence, but nonetheless, the Bank of England are also on an easing path. I'd say what's different here is they're a little bit more cautious in terms of the pace and in terms of their communication. They seem to have been a little bit more resistant. Now, why is that? So first of all, activity has been relatively strong in the first half of the year, and underlying inflation is still a little bit elevated actually compared to the path that we see in Europe, for example. So that has really been driven by a very tight labour market. Wage growth was quite elevated in the UK. Again, so it's a similar story of headline inflation is coming down, but it's that core wage story that has been a key focus for the Bank of England. So they were much more resistant to starting to ease. But the tone is starting to shift a little bit. Monthly GDP has flatlined recently. So there is signs that whereas you had above trend growth in the first half of the year, the UK is also experiencing a bit of a slowdown. Some of the business sentiment surveys have started to decelerate somewhat. And so really the MPC, the Monetary Policy Committee, are going to be focused on the inflation numbers as well as growth. Service inflation is really where there was that stickiness, but it's starting to really roll over a little bit. The labour market is showing signs of easing. Vacancy rates are starting to decline. Some of the labour market indicators are not that clean. We have some measurement issues, so you can't fully rely on the unemployment rate at the moment. But again, there are signs in business surveys of employment or hiring expectations are starting to ease. So putting all of this together, we're now expecting a 25 basis point cut again in November. And so two cuts this year, and then a steady pace of easing next year. But this has been a slower path for the Bank of England than say in Europe from the ECB. And definitely we're not going to see those big bang 50 basis point cuts from the Bank of England anytime soon. It's a more cautious approach there for sure.
Yeah, and they'd also have cheaper access to money and to funds as well. Yeah. All right, excellent. That's a good summary of the US. And now I think we will go to the country where Sree currently lives and where I'm originally from. So now we will talk about the UK economy in general. It's pretty good because on this channel we talk a lot about what happens in the US market. So it's really good to have somebody on who has a real touch on the UK market specifically. So I just wanted to get a very similar summary for you about what's happening in the UK economy, and then we'll drill into that in a little bit more detail. Yeah. So do you think it will be similar to the ECB and maybe a little bit to the US, but like at a delayed process because they were late to increase the interest rates and they were late to decrease the interest rates?
Well, I think yes, and there was. I think they were correct to wait, and it's quite interesting to see for markets at least. It's not just what they do; they have been moving. They prepare the markets quite well in terms of the communication. But more recently, there's been a lot of will they, won't they, and it's really the vote split that's also part of the communication. The first cut was really finely balanced. And I think it was it a 5-4 split in terms of the vote. So it's not a consensus by any means. They are going to be data dependent. Any sort of shift in terms of inflation, they are going to hold. So I would say that for now, everything is pointing towards a couple more this year. But that wasn't our view that not so long ago. We were expecting them to hold in November, but the data has evolved to suggest that a 25 basis points cut would be in line with the outlook for the Bank of England. So, yes, they have joined the party, but a little bit more cautiously as well. And you have the QT side of the story as well. That again is a very gradual and predictable manner over time. That's something that they've signaled in the last meeting as well. So there's a bit of a shift there in terms of they're easing, but they still have that quantitative, the bond sales as well in the sideline there. So a gradual path overall from the Bank of England.
Okay. And obviously there's been a Labour government for only a short period of time. They've only fairly recently come into power after being Conservative-run government for a very long number of years before that. How do you expect there to be changes between the two political parties now Labour is in, and how do you think that will impact the economy?
I think if you take a step back, we've had quite a few prime ministers in a short space of time. So if this heralds a new era of stability, that's great news. In terms of market sentiment, I think that would be quite positive. There is that just this week we had the International Investment Summit, which was really hosting a global set of big firms, CEOs. It was really trying to attract investment into the UK. And the tone from the Prime Minister and the Chancellor was taken quite well, I think, from within the media. There is the backdrop of fiscal constraint, and we do have a budget coming up. So the summit was held just before the budget, which is later this month, the end of this month. There isn't an awful lot of fiscal headroom there, so there'll be some constraints. So far, what's been leaked in the media has been a range of tax hikes that potentially the numbers have been quite wild in terms of the range. The Prime Minister has tried to talk down some of the higher end of those numbers. But nonetheless, we have been told of a big fiscal hole in the region of like £20 billion. And they've tried to manage this sort of the wage increases for some public sector workers that have been long overdue versus trying to fill that fiscal gap. So it is going to be quite a challenging budget. It was initially flagged as a painful budget, but I think there are going to be limits to how much they can actually deliver within the framework. So there might be some accountancy tweaks. They are talking about maybe changing some of the way the Bank of England losses on bond sales are going to be accounted for. That might be taken off that balance sheet. So there are some accountancy tweaks that can be done. However, that will create a little bit of fiscal room, maybe some plans for investment. But these investment plans are very much long term. They're necessary, but they are very long term. You won't see the impact of them immediately. So this is something that can materialize over the course of, but again, the details aren't necessarily there. But it seems that some of the turbulence that the UK has been through over the recent years, some of that has settled. The market sentiment has settled somewhat. And that in itself is good news. If there's stability in the bond market, stability in equities and the currency, that can only help in terms of navigating the economy going forward.
And I think you're right. I think they have been prepping the market that it could be a potentially painful budget to try and manage expectations when the budget actually happens. One of the other things that I've heard a lot of rumors around is around potential tax hikes. And in particular, I heard a rumor about potentially increasing capital gains tax. Have you heard anything similar? And are you expecting that those sort of tax hikes could come in place in the new year?
We'll find out in the October budget, and that's exactly one of the tax hikes that the Prime Minister was addressing as well, in terms of his response was very much, we can't tell you numbers right now, everything will be revealed in the budget. Some of the rumours are quite high. I think they have to find the balance between raising revenue that's necessary, but also you don't want to hurt businesses and households in the process. So some tax loopholes will be closed in terms of carry income for private equity. Those sort of measures will be detrimental to certain businesses, but perhaps it's less detrimental to the overall economy. Those are the kind of measures that they are discussing at the moment. So I think there are some nuances within the detail in terms of how they raise revenue, but a very high capital gains tax would not necessarily be a healthy for the economy, but obviously that they have to get that at the correct level. So I don't put too much weight on some of the media speculation. But also there is an element of smart politics. You say it's going to be painful, perhaps the market reaction will not be so severe afterwards. So you have to bear these different aspects in mind. But ultimately, it will be the October budget that will reveal the details, and then hopefully we'll have some business certainty, and business decisions can be made more concrete, and sentiment should hopefully stabilize.
Yeah. That kind of feels to me like a way of signaling to the market that we're going to tax the rich, because it's a nice way to get a reaction from the country. But we have seen a lot of high net worth individuals have started to move to countries with easier tax situations. So it might not necessarily be a great thing if they do increase those capital gains tax, but only time will tell, I suppose.
I think this is exactly what they're balancing, the need to raise revenue and the need to induce more business confidence as well. And that was really the signal from this week that I took away from the summit.
Yeah. Okay, excellent. And the last thing I wanted to ask you about is, in light of what a lot of the things that you were saying about the instability in the UK over the last couple of years, the change of leadership, etc. And we've also seen lower valuations of UK equities against US equities in terms of all of the valuation metrics. Do you expect that could potentially correct? And what are some of the reasons why you think that there is a big gulf in the valuations between UK equities and US equities?
Yeah, I think first of all, it's important to note the composition of the different indices. Whereas the FTSE 100, which is what investors normally think of when you think of UK equities, it's very big international firms. For one, it's very globally exposed. The currency is very important for it. But also, if you think about the composition, it's more sort of energy, mining, financials, consumer staples. The S&P 500, even though it's quite a broad set of sectors, it's been driven, as we said earlier, by the Magnificent Seven. So again, the valuations can be partly explained by the composition. We don't have the big technology companies necessarily. So that's one idea. The currency is a big part of the FTSE's quoted in sterling, so currency movements are very important. But also, potentially investor sentiment towards the UK post-Brexit has been a little bit different. And there's been this attitude of, well, if you're going to buy an index, maybe the US. But I think now, as I mentioned, we do have more political stability and potentially some clarity in terms of the policy outlook. But that won't necessarily impact the FTSE 100. Perhaps the mid cap, small cap, the domestically focused companies, there could be some interesting opportunities there going forward. But ultimately, the FTSE 100 is going to be global exposure. What's happening, like questions for any economy, really. What's happening in terms of China growth, trade with China, US growth outlook? Those are the questions that would be driving the big global companies in the FTSE 100, while the domestic story, whether it's interest rates or the fiscal outlook, that would be driving more the mid and small cap economies. But it does seem that if you have bond market stability, that was that obviously we had the mini budget a couple of years ago. That did lead to a lot of turmoil and perhaps a sentiment issue for the UK. I think we've moved well beyond that now. And I think, there's a clear communication from the Labour government. It's not necessarily going to be an easy budget, but what's needed for market sentiment will be, domestic market sentiment will be a clear plan there in terms of the fiscal story. But I would just flag again that the FTSE 100 is global, so the interest rates and budget is not necessarily going to be that big a driver there. It has a strong beta to the US, and what's happening in China, for example, that would be affecting global markets and the FTSE 100 likewise.
When the US sneezes, the rest of the world catches a cold, right?
Yes, that's the saying, yes. And the UK has very much got a beta to the US for sure. Yeah.
Yeah. Okay. All right. Right. That's a great segue because you mentioned China in the just before at the end of that summary. I want to talk to you more about China now because it's been pretty interesting over the last couple of months. We have seen a big uptick in Chinese stocks and stocks in the Hong Kong stock market. And I guess that's mainly to do with the stimulus that China have put into the economy over the last. Can you just explain a little bit about what's been happening in the Chinese economy recently and some of the stimulus things that they've put in place in order to boost the economy?
Yes, I think just going back to the sharp increase in the stock market, it's been quite dramatic, like a vertical line on the chart. So prior to that, there had been a pattern of surprise press conferences and some policy announcements. So I think there's been a lot of sentiment just around this policy direction. So China's economy has really been dragged lower by the problems in the real estate market. And so far over the last year, there's been very incremental tweaks in the interest rate. They have a series of interest rate measures that they can use to manage the economy, but the response to the real estate market, or the real estate drag, has been fairly limited so far. There were some measures directed at supporting construction or real estate, but these have been fairly small. If you think back in the past, the great financial crisis, there was a huge stimulus effort that not only supported China's economy, but the global economy as well. That package from many different economies together was quite important in preventing a depression style, very serious global recession. So within that context, these are all very small. So if you then move from a 10 basis point interest rate cut to, say, 15 or 20, it looks incredibly large. And it's a big surprise for the markets. And I think that's helped fuel some of this sentiment or speculation around there is big stimulus yet to come from China. And I think there is more to come, but it might be under relative to the expectations that have currently been set up. So, for example, this weekend, there was a lot of focus on what could be announced in the press conference. And again, it was just, it wasn't the sugar high that was expected. There was some support in terms of fiscal stimulus, there weren't cash transfers to households, but there was support for students. There is some further measures for local government money there, local government bond issuance. There are some measures being implemented, but overall these have a relatively low multiplier for the economy. But again, there's a lot of speculation there. Some of that has unwound. So I think some volatility for the Chinese stock market could be the outlook in the near term if there's a disappointment there from the Ministry of Finance. But they are trying to make sure that the overall growth picture is supported, but they do have a growth target of around 5%, and that's challenging to reach given the dynamics of the economy. They have been trying to shift towards, bolstering the consumer, but these measures don't really go towards a strong consumer at the moment. That sort of tweaks around the edges there. So I'd be a little bit careful of interpreting too much around this and too much around the stock market rally.
Yeah. So you think in terms of the economy rather than just how the stocks are moving, you think that it's probably the stimulus is probably not enough really to start to boost the consumer to spend much more money, right?
If they had bigger cash transfers to households, helping families with, I think there are measures to help families with two children or more. But the measures as they stand, it's not a big flow, big boost to household incomes. So I think you could have more measures incrementally in the future, and that could turn the story around. But we're not seeing it it's not really matching up to some of the speculation ahead of these press conferences, to be honest.
Yeah. All right. And how well contained do you think is the housing crisis that's been happening in China? Obviously, there was extremely high inflow of new houses that were coming up on the market all the time. People were buying second houses, third houses as investment property. And really, the Chinese were using the real estate more as a store of value rather than for people to actually live in. Do you feel like it's well contained, or do you think that there could still be some pain points to go?
I think it does seem that that speculative process is very much behind now. That was from a few years ago, and some of those investments, those investment strategies have been quite painful. So that speculation is pretty much behind. Now there's concern about, has this real estate market troughed, and that's really the focus. And it seems to be, there could be potential downside risks from here, but I think the aim is to draw a line underneath this, and that seems to be the policy mix at the moment. It's not necessarily going to lead to the next sort of real estate housing boom, but a stability there seems to be really the aim of the policy mix that we're seeing. But obviously, there are some downside risks, but I think the bulk of that pain is probably behind us now. And really, the aim is to try and just reach that growth target there and shift that mix of investments. There's a much more open equity market there. There are other investment opportunities, but before you can get there, you really need to stabilize household incomes and the underlying growth picture before you can.
Yeah, I agree. I think they could do with the period of stability for a while. Forget about growth. Just try and keep the housing market stable and try not to cause any more issues with it. All right, we're going to take a trip now over the sea to Japan and finish up on Japan. And pretty interesting what's been happening in Japan over the last year or so. Obviously, there was the Japan carry trade, which I'll let you talk a little bit more about. But I wanted to talk about Japan, but I wanted to focus more on the Japanese yen and some of those policy decisions that the Bank of Japan have got to be making.
Yes, I think it is very interesting in that the Bank of Japan has been a central bank outlier for decades, really. While other central banks were hiking rates, Bank of Japan had negative interest rates at minus 10 basis points for a meaningful period of time. They also had yield curve control, which was suppressing bond yields. So you had big market, bond market distortions. And obviously, you had a very weak currency. But that really is the perfect backdrop for the carry trade. And so you can borrow cheaply in yen and use that to fund investments in Mag 7, for example. So that's your classic carry trade characterization. But over the summer, what we saw was a very sharp moves in the yen. So where there's been a lot of pressure and speculation about what the Bank of Japan will do, they have started normalizing policy, although you still have interest rates at 25 basis points, very low relative to where we are, even with Western central banks or other developed markets easing. You still have this massive interest rate differential, which means you're going to have a very weak currency. And so this interest rate differential means that you still have the perfect backdrop for the carry trade. But over the summer, what happened was you had a very hawkish Bank of Japan decision. They raised rates. They had a very hawkish tone. They raised rates by a little bit more than the market was expecting. They have a habit of surprising markets. But I think going forward, they're going to be very careful about that. They will want to really communicate and signal their direction and make sure it's priced into the markets. Why? Because in August, they raised rates, and this was at a time when the yen was at historically cheap levels, and it had moved to these cheap levels at a very rapid pace. So that was mainly speculation. So it moved from around 140 to close to reached 160 within the space of a few weeks. That was very dramatic. The Bank of Japan were trying to rein that in, but in doing so, they did it at a time when suddenly there was some very weak data from the US. There was a repricing of expectations around what the Fed would do. So that then led to not actual policy moves, but a repricing within money markets, which then led to a sharp move, a rally in the yen, and a disruption and spillovers across the carry trade space. So it led to, I think, Japanese equities were one of the worst performers, but very sharp sell off in Max 7, in tech stocks. There were some poor tech earnings as well. So I would say it was a perfect storm of events that all happened within the space of, I don't know, 48 hours, which led to this dramatic sell off in the markets. Also, it's August, so liquidity was very thin. Everyone's on holiday. So you can tend to get these big moves. Now, I would say that was a one off, but going forward, there is still risk of a carry unwind shock. They could be brief. And I think the Bank of Japan and the Fed actually are very conscious of market stability. The Bank of Japan still need to raise rates, but they will be doing so at a very steady pace. Why have they been an outlier? Well, because they've been through decades of deflation and very low inflation. Finally, partly through the pandemic, as with everyone else, they have some inflation now, but a lot of this is exported. They have a weak yen, so they're exporting food, energy, and all of this is driving their inflation. What the Bank of Japan really want to see is higher wages. And that's been a struggle. When you have decades of deflation, it's very difficult to shift that mindset. So if you start raising prices, you pass on your input costs, what is Japanese consumers start to rein in their spending. And so that's been a very difficult backdrop. So you need to see that mindset shift. You need to see higher wages. The Bank of Japan's starting to see that in the Japanese economy. We are on the correct path there, but they have a problem with markets now. The Bank of Japan have been on this kind of tug of war with markets for at least through the last 3 years. That's been the real story. Market speculation, Bank of Japan trying to manage that. And I think that's very much the case. Only this time, I think it's going to be very difficult for them to surprise markets. They don't want to see that turbulence again. Albeit the perfect storm situation was very different over August. I think they're in a different environment now, but they have to really communicate and make sure they don't create that disturbance. And that's something that's in everyone's interest. That's not a Japan story. That's for all markets. This yen carry trade is very significant, and the estimates are really wide. But it goes into trillions of dollars. So this is something that can't be ignored. And Japan, I would say, is quite an important story to follow, not just when it suddenly hits us in the face. It's something that we need to really pay attention to as well going forward.
Yeah, they really are stuck between a rock and a hard place, really, because the Japanese yen is weakening against the US dollar and other major currencies. But it's very difficult for them to raise their interest rates because of these Japanese uh, trade unwinds and the effects that it might have on the rest of the global stock market. So yeah, I don't envy the position, but I think communication, as you said, is going to be the key factor. They're going to have to flag it and give people time to move out of their positions without shocking the market. Yeah. Okay. And on the Japanification of the markets, so obviously, Japan have been doing quantitative easing for a long time, many decades, right? And what we've seen is their debt to GDP is up over 200%. I think, can't remember what it is. I think it's out 220 or 230%, something like that. And we're seeing a pattern of that happening more in the UK, in the US, the UK, and in Europe. It's that number is increasing. How do you see the Japanification of the other markets, such as the US and the UK, in the future? Yeah, they really are stuck between a rock and a hard place, really, because the Japanese yen is weakening against the US dollar and other major currencies. But it's very difficult for them to raise their interest rates because of these Japanese uh, trade unwinds and the effects that it might have on the rest of the global stock market. So yeah, I don't envy the position, but I think communication, as you said, is going to be the key factor. They're going to have to flag it and give people time to move out of their positions without shocking the market. Yeah. Okay. And on the Japanification of the markets. Sorry about that. So obviously, Japan have been doing quantitative easing for a long time, many decades, right? And what we've seen is their debt to GDP is up over 200%. I think can't remember what it is. I think it's out 220 or 230%, something like that. And we're seeing a pattern of that happening more in the UK, in the US, the UK, and in Europe. It's that number is increasing. How do you see the Japanification of the other markets, such as the US and the UK, in the future?
I think it's I'd say because people often compare Japanification story, they often compare that with what's happening in China at the moment, because China's inflation is incredibly low. Core inflation, I think, was just flat. So they're flirting with deflation there. That's not the case in the US and UK. We have really relatively elevated core inflation in those countries. But I would say that Japan is quite different if you think about the story. The sort of the seeds of that Japan deflation story really stem back to the 1990s. You had an asset bubble there that burst, and there was also some underlying issues in terms of the corporate structure as well, and all of these factors are now changing in Japan. So you had a lot of cross shareholdings of firms holding each other's shares. So it was very, all of that needed to be disentangled over time. There was a process of deleveraging that was happening. Balance sheets needed to be cleared up. And that took a very long time. But also within that, there were periods of policy error where you would have a VAT hike or you would have interest rates rising a little bit. So the full scale of deflation, I'd say it was a bit of a deflation experiment for the rest of the world to really watch and learn from. And that's why the Bank of Japan have been so cautious in terms of removing ultra easy monetary settings. They have to do this very carefully because of that, as I mentioned, the deflation mindset. So this is very unique to Japan. Bank of Japan have been at the cutting edge of monetary policy tools over the decades because of this situation. So yield curve control, for example, that's something that, a negative interest rates, that, this is all from the Bank of Japan, these innovations in monetary policy as a result of this experience in deflation and tackling deflation. But I think the key message is once you fall into that deflation trap, it's very difficult to get out. And that's something that other central banks have learned from. And you can see that in China as well, in terms of the stimulus really that we're seeing in China. They're very careful not to make that same policy error. So I'd say the Japanification story seems like it's very much contained. In the past, about 10 years ago, people were talking about Japanification of Europe, for example. But again, these monetary policy tools are in place. They can be implemented quite quickly. And I'd say going forward, Japan are very keen to move out of this situation, and a lot of changes have been made. So corporate reform is huge in Japan. And I'd say that's going to be a very big foundation for the Nikkei and for Japanese equities going forward. So yes, they're struggling a little bit at the moment. Timing of entering the market is still a bit fluid. There are a lot of uncertainties. But in terms of structural trends, the Japan equity story is still quite strong as the Bank of Japan and the economy moves out of deflation. Even if it's very low inflation, it's still a long-term story there to get wages really growing. The foundations are very much there, and that corporate reform story is still ongoing. And also, Japan is very cleverly spaced in terms of where they sit in the global value chain, in terms of autos production, in terms of semiconductors. So it's a very interesting story there. So it's not all doom and gloom. I'd say that the fact that they've positioned themselves within autos within hybrid space, rather than trying to, like in Europe or Germany, trying to bridge that gap to go directly to EVs. It's very difficult to compete with China on the EV story, but Japan have been very clever, positioned within hybrids, taking into account that the EV infrastructure is not fully fledged yet. So they're making a very slow and clever transition within that auto space. So I'd say there's a lot of positives, longer term positives for Japan. So yes, we had a massive rally a year ago. This year it's been treading water, pulled back a little bit, but it'll be a very interesting space for 2025 onwards, I'd say, in Japan. So I wouldn't fear Japanification. I think Japan's coming out of it, and other countries have learnt from that story. So I'd say it's fairly contained.
Yeah, I agree. It's important to learn those lessons because people are calling in China, they're calling for more stimulus because they want more money in the economy and they want to prop it up and they want more prosperity, etc. But you've got to be extremely careful what you wish for, right? Because you put that money into the economy, and as you said, it's very difficult to be weaned off that stimulus when the time comes to it, right?
It's about inflation expectations, I think, in either direction. Whether it's a wage price spiral that leads us back to the 70s or a deflation spiral, I think expectations are key in either directions. And that is the challenge for central banks.
Perfect. All right. Well, excellent summary. The last question I had for you, Suri, is how can people find out more about you as a person? And also, how can they find out more about some of your research work and more about Aberdeen as well?
Yes. So the research is all available on abrdn.com, and we'll have a list of articles covering all of these themes. And I'm also available on LinkedIn as well. I have a weak attempt at Twitter, but mainly LinkedIn. I'm not very, we're not prolific on Twitter, but all of my updates are on LinkedIn.
Excellent. All right. Well, it's been really great talking to you today. I think we've gone over a number of different topics from all of the economies around the world. So I think the audience is going to get a great deal from listening to this interview and hearing your experience and your insights.
Thank you for having me. It's been great to join you on the show. Thank you.
Excellent. All right. Well, it's been really great talking to you today. I think we've gone over a number of different topics from all of the economies around the world. So I think the audience is going to get a great deal from listening to this interview and hearing your experience and your insights. So thank you very much for providing us those today.
Thank you for having me. It's been great to join you on the show. Thank you.
Yeah. And I hope you can come on later in the future and we can dig into some more topics.
Would love to. Thank you.